Something has shifted in the silver market. Not the kind of shift that makes headlines for a day and disappears, not the social media frenzy that comes and goes with the algorithmic wind. This is structural. This is quiet. And if you hold silver, or if you've been watching from the sidelines, wondering when the right time might come, this is a conversation you need to hear. I'm not here to tell you silver is going to the moon tomorrow. I'm not here to promise you generational wealth in 6 months. What I am here to do is walk you through what's happening right now in the physical silver market, why it matters, and what it means for anyone trying to navigate this environment with discipline and clarity. Because here's the truth. The supply situation in silver has moved from theoretical concern to measurable reality. Refineries are reporting delays. Premiums on physical metal have widened in ways we haven't seen outside of crisis moments. Industrial users are securing supply further in advance than normal. And the investment community is starting to notice. This isn't about prediction. It's about observation. It's about understanding what happens when a market that's been ignored for years suddenly becomes constrained at the exact moment demand is accelerating. And it's about making sure you're informed, not reactive. So let's begin where all honest analysis must begin, with the facts as they exist today, the context that explains them, and the framework for thinking clearly when uncertainty rises. The silver market has always been unusual. It sits between two worlds, industrial commodity and monetary asset. That duality has made it volatile, misunderstood, and frequently dismissed by mainstream investors who prefer cleaner narratives. But that duality is now creating something rare. On one side, industrial demand for silver is climbing. Solar panel manufacturing alone has consumed silver at rates that have surprised even industry analysts. Electric vehicles use more silver than traditional cars. 5G infrastructure, electronics, medical applications, the list of industrial uses keeps expanding, and none of these technologies are slowing down. On the other side, investment demand is waking up. Not in the explosive manic way that characterized 2011 or the brief social media surge in 2021. This is different. This is institutional. This is pension funds and sovereign wealth starting to ask questions about monetary metals again. This is retail investors in multiple countries quietly accumulating on a scale that doesn't make daily news, but shows up in mint sales data and dealer inventory reports. Now here's where it gets serious. Annual silver mine production has been essentially flat for years. There's no surge of new supply coming online. In fact, the easier deposits have already been mined. What remains requires more energy, more capital, and more time to extract. Recycling helps, but it doesn't come close to filling the gap when both industrial and investment demand are rising simultaneously. The math isn't complicated. When you have relatively fixed supply and rising demand from multiple directions at once, something has to give. Either price adjusts to ration supply or physical availability becomes constrained, or both. We're now seeing both. Delivery times on physical products have stretched. Premiums over spot price have widened significantly in certain markets. Some dealers are reporting difficulty sourcing specific products. These aren't rumors. These are observable market conditions that anyone can verify by calling dealers or checking mint backlogs. This doesn't mean the sky is falling. It means the market is tightening. And when markets tighten, the people who understand what's happening and prepare accordingly tend to do better than those who panic or ignore it entirely. Let's talk about why this situation catches most people off guard. Because understanding the psychology of markets is as important as understanding the fundamentals. First, silver has been in a long consolidation. After the 2011 peak, it spent years being forgotten. While other assets made headlines, silver just existed. It didn't crash spectacularly. It didn't rally dramatically. It became boring. And in financial markets, boring means ignored. When something has been ignored long enough, people develop mental shortcuts. They assume nothing important is happening. They assume if something truly significant were occurring, they'd hear about it on the evening news or see it trending online. But major structural shifts don't announce themselves with fireworks. They build slowly beneath the surface until the day the surface can no longer hold. Second, most people confuse paper price with physical reality. When they look at silver, they see the spot price on their screen and assume that's the whole story. But spot price is largely determined by futures contracts traded on exchanges, contracts that are often settled in cash, not metal. It's a price discovery mechanism, yes, but it's not the same as the price at which you can actually acquire physical silver in quantity when you want it. The divergence between paper price and physical availability is one of those market anomalies that can persist longer than seems logical, right up until it can't. We've seen hints of this divergence before, during moments of stress. What makes this moment different is the duration and the breadth. It's not just one product or one region. The tightness is showing up across multiple markets simultaneously. Third, people underestimate how small the silver investment market actually is. The entire above-ground investment silver supply, all the coins, all the bars held by investors worldwide, represents a fraction of the capital in global equity markets or bond markets. When even a modest percentage of investment capital decides to allocate to physical silver, it doesn't take long for that capital to overwhelm available supply. This isn't theory. We've watched it happen in other commodities. We've watched it happen in previous precious metal cycles. The pattern is consistent: long periods of apathy, followed by rapid tightening when sentiment shifts. The final misunderstanding is about timing. People want to know exactly when something will happen. They want precision. But markets don't work that way. Structural changes build pressure over time, and that pressure releases when it releases, sometimes gradually, sometimes suddenly. The job of a disciplined investor isn't to predict the exact moment. It's to recognize the conditions and position accordingly before those conditions become obvious to everyone. Right now, the conditions are no longer theoretical. They're measurable, and that changes everything. You cannot understand what's happening in silver without understanding what's happening in the broader financial system. These markets don't exist in isolation. They're connected by invisible threads of capital flow, currency dynamics, and investor psychology. Let's start with the obvious. Global debt has reached levels that would have seemed impossible 2 decades ago. Government debt, corporate debt, household debt, all at historic highs relative to GDP. This matters because debt of this magnitude creates constraints. It limits how high interest rates can realistically go without triggering cascading defaults. It creates constant pressure on central banks to manage the system carefully. When interest rates rose sharply in 2022 and 2023, many assumed we were returning to a traditional monetary policy regime. But look at what actually happened. Rates went up, stress appeared in regional banks, cracks showed in commercial real estate, and suddenly the conversation shifted. Central banks are trapped between inflation they want to control and a debt structure they cannot allow to collapse. This is the environment we're operating in now. It's not 1980, it's not even 2008. This is something different, a system carrying unprecedented debt while trying to maintain credibility in currency and sovereign bonds. Now, what does this have to do with silver? Everything. Silver, like gold, exists outside the debt system. It's no one's liability. It can't be printed, debased, or restructured by committee. When confidence in debt-based assets wobbles, even slightly, capital begins looking for alternatives. Not all capital, not immediately, but enough to matter in a market as small as physical precious metals. We're also watching inflation dynamics that remain more persistent than central banks predicted. Official inflation numbers have come down from their peaks, yes, but they remain above stated targets, and more importantly, the damage to purchasing power over the past few years has been significant. People feel poorer because, in real terms, they are poorer. Their savings buy less. Their wages haven't kept pace. This creates a psychological shift. When people lose confidence in currency stability, they don't necessarily rush into silver on day one, but they start asking questions. They start researching. They start looking at alternatives. And once that process begins across a large enough population, market dynamics can change quickly. There's also the geopolitical dimension. We're living through a period of declining trust in global institutions, rising tensions between major powers, and increasing economic nationalism. Nations are rethinking supply chains. They're rethinking reserve assets. They're rethinking what security means in a multipolar world. Silver sits at the intersection of industrial necessity and monetary hedge. For countries thinking about energy independence, silver is critical for solar infrastructure. For countries thinking about monetary security, silver offers a physical store of value. This dual use makes it uniquely positioned in the current environment. Interest rates deserve special attention. When rates were near zero, the opportunity cost of holding non-yielding assets like silver was minimal. When rates spiked, that calculus changed temporarily. But here's what many miss. If rates stay elevated, while inflation remains persistent, real rates, the rates adjusted for inflation, may still be negative or barely positive. In that environment, the opportunity cost of holding physical assets diminishes again. We're also seeing currency pressures beyond just the dollar. Multiple major currencies have weakened against hard assets over time. The yen, the euro, the pound, all have lost purchasing power when measured against real goods and commodities. This matters because silver is priced globally, but purchased in local currencies. When your currency weakens, the local price of dollar-denominated commodities rises even if the dollar price stays flat. All of these macroeconomic forces, the debt burden, the inflation persistence, the currency instability, the geopolitical fragmentation, they're not about to resolve tomorrow. They're structural. They're the landscape we're operating in. And in this landscape, physical assets with industrial utility and no counterparty risk start looking less like speculation and more like sense. Let's look backward to understand forward. Not because history repeats exactly, but because human behavior in markets follows recognizable patterns. Silver has always been cyclical. It goes through long periods of neglect followed by shorter periods of intense interest. The cycle from the late 1970s to 1980 is well known. Silver went from around $4 to $50 in a remarkably short time. Then it crashed and spent 2 decades working its way back. What caused that surge? A combination of inflation fears, currency instability, geopolitical tension, and yes, some speculative excess at the peak. But the initial move was driven by real concerns about monetary stability and physical accumulation by investors who saw the writing on the wall. The 2008-2011 cycle followed a different path, but similar psychology. Financial crisis, massive central bank intervention, concerns about currency debasement, and silver went from single digits to nearly 50 again. The move was powerful because physical buying from around the world converged at once. What happened after both peaks? Sharp corrections, long consolidations, and a generation of investors who got burned buying at the top and swore they'd never touch silver again. This is important to understand because it explains why silver has been so ignored in recent years. The scars from previous peaks create resistance to the next cycle. But here's the pattern. The cycles keep happening. The consolidations end. New buyers who weren't burned before enter. Industrial demand continues growing because technology doesn't stop advancing. And eventually, the combination of tight supply and rising demand creates another cycle. We're not trying to call a top here. We're not saying silver is definitely going to 50 again. What we're saying is that the conditions that precede major moves are present: extended consolidation, tight physical supply, rising industrial demand, macroeconomic uncertainty, and early signs of investment interest returning. The investors who do well in these cycles share common traits. They buy during the boring periods, not during the mania. They understand position sizing and don't over-leverage. They focus on physical metal, not leveraged paper products. And they have patience to hold through volatility. The investors who get hurt follow a different script. They hear about silver from a friend or see it on social media after it's already moved significantly. They buy emotionally, often with money they can't afford to lose. They expect immediate results. When the inevitable corrections come, they panic and sell at a loss. If you study market history across all asset classes, this pattern is universal. The disciplined early adopters transfer wealth from the emotional late arrivals. It's not personal. It's not even particularly complicated. It's just how markets work. Right now, we're not in the mania phase. We're in the phase where informed investors are noticing the supply situation and quietly positioning. Premiums are rising, yes. Physical is harder to source, yes. But this hasn't hit mainstream consciousness yet. That's the window. That's when disciplined accumulation happens. One more historical note. Every major precious metals move has been dismissed as a bubble by mainstream financial media until it wasn't. In 1979, gold and silver were called barbarous relics by sophisticated economists right up until they exploded. In 2009, precious metals buyers were called paranoid gold bugs right up until they weren't. The consensus is always behind the curve because the consensus is built on backward-looking data and recency bias. You don't need the consensus to be right. You just need to understand the conditions and act accordingly while the opportunity exists. If you already hold silver, you're facing a different set of questions than someone who doesn't. Let's address your situation specifically. First, recognize that you've already done the hardest part. You acquired physical metal, likely during a period when it wasn't popular or exciting. You stored it. You held it through periods where nothing happened. That discipline is rare, and it matters. The supply tightness we're seeing now validates your thesis. It doesn't mean you were lucky. It means the reasoning that led you to hold silver is playing out in observable market conditions. This is confirmation, not cause for celebration or complacency. Your next question is probably, what do I do now? The answer depends on your personal situation, but the principles are universal. If you hold silver as a long-term store of value and insurance against monetary instability, nothing has changed about that thesis. In fact, the macroeconomic environment has arguably strengthened it. The case for holding physical assets outside the banking system is as strong as it's been in years. The supply tightness simply adds another dimension to that case. If you hold silver expecting to eventually exchange it for other assets when the relative value makes sense, you're in a position to be patient. These supply situations don't resolve overnight. When physical metal becomes genuinely difficult to source, prices tend to adjust more than people expect because buyers become less price sensitive when availability is the constraint. This doesn't mean hold forever regardless of conditions. It means you can afford to wait for genuine value recognition rather than reacting to short-term price movements. The difference between paper price volatility and physical availability creates opportunities for those patient enough to see them. One thing you should absolutely not do. Do not get shaken out by short-term volatility. Paper markets can be volatile even when physical markets are tight. We've seen this before. Futures markets can get pushed down while physical premiums rise. It looks contradictory, but it's actually information. It tells you where the real supply-demand dynamics are versus where the leveraged trading is happening. Another consideration, if you've been holding silver for years, you might be looking at a significant unrealized gain depending on when you acquired it. This is where discipline matters most. Gains feel good, but they're not real until you decide to exchange them for something else. The question isn't whether you have a gain. The question is whether the conditions that led you to hold silver have fundamentally changed. If they haven't, and I'd argue they haven't, then holding through volatility makes sense. Finally, consider whether your position size still makes sense for your overall situation. If silver has appreciated and now represents a much larger percentage of your portfolio than intended, rebalancing might be appropriate. If it's still a modest position and your circumstances allow, the current environment might actually argue for patience or even modest additions during dips. The key is to think in terms of conditions and probabilities, not emotions and predictions. The conditions favor silver holders right now. That doesn't guarantee any specific outcome, but it shifts the probability distribution in a favorable direction. If you don't currently hold silver, but you're watching this situation unfold, you're likely asking yourself, is it too late? Have I missed it? Should I wait for a pullback? These are natural questions, but they're often the wrong questions. The right question is, do the fundamental conditions justify holding some physical silver as part of a diversified approach to wealth preservation and potential appreciation? If the answer is yes, if you understand the supply dynamics, the macroeconomic backdrop, the historical patterns, and they make sense to you, then the question of timing becomes secondary to the question of positioning. Let me be clear, I'm not telling you to rush out and buy silver tomorrow morning. I'm telling you to think carefully about your situation, educate yourself on what's happening, and make decisions based on understanding rather than emotion. The supply tightness is real, but it's not at crisis levels yet. You can still acquire physical silver. Yes, premiums are higher than they were. Yes, you might face some delays depending on what you're buying, but the market is still functioning. The window hasn't closed. What you should absolutely not do is wait for the perfect entry point. There's no bell that rings. There's no sign that flashes saying, buy now. By the time silver is making mainstream news every day, by the time everyone agrees it's a good idea, the easy gains are gone and the volatility is extreme. The disciplined approach is to start small, educate yourself, understand what you're buying and why, and build a position methodically over time if it makes sense for your situation. This isn't about going all in, it's about appropriate allocation based on the potential risks and rewards you see in the broader financial landscape. Consider starting with a modest position that wouldn't be devastating to your finances if silver dropped 20 or 30% from here. Precious metals are volatile. They will test your conviction. If you're not comfortable with that volatility, you'll sell at the worst possible time. Better to hold a smaller position you can sleep with than a large position that creates anxiety. Also think about form. Physical silver comes in different products, coins, bars, rounds, each with different premiums, liquidity characteristics, and storage considerations. Educate yourself on these differences. Talk to reputable dealers. Understand what you're buying before you commit capital. One more critical point. Don't borrow money to buy silver. Don't use leverage. Don't take funds you need for living expenses or emergency reserves. Physical precious metals are a long-term hold for most people. They require patience. If you're forced to sell during a downturn because you need the cash, you've already lost regardless of the long-term thesis. The opportunity here isn't to get rich quick. It's to position yourself appropriately for a financial environment where physical assets with no counterparty risk and genuine industrial utility become increasingly valued. That's a measured, thoughtful approach, not a gamble. Let's talk about mistakes. Because in situations like this, what you don't do is often more important than what you do. First, don't react emotionally. If you see silver spike 10% in a day, that's not a signal to rush in. If you see it drop 10%, that's not a signal to panic sell. Volatility is noise. The underlying supply-demand fundamentals change slowly. Your decisions should be based on those fundamentals, not daily price action. Second, don't chase headlines. By the time a story is everywhere, the easy opportunity has usually passed. More importantly, headline-driven investing leads to buying high and selling low because headlines follow price, not the other way around. Third, don't over-leverage or use complex derivatives you don't fully understand. The leverage that magnifies gains also magnifies losses. The futures contracts and options that seem like smart ways to maximize exposure can lead to total loss if the timing is wrong. For most people, physical metal is the appropriate vehicle. It's simple, it's real, and it's yours. Fourth, don't assume this is a straight line higher. Even in the strongest bull markets, there are corrections that shake out weak hands. If you enter a position expecting immediate validation, you're setting yourself up for emotional decision-making. Expect volatility. Prepare for it mentally. Have a plan for how you'll respond if prices drop 20 or 30% from your entry. Fifth, don't blindly follow online personalities or social media hype. Yes, there are knowledgeable people sharing genuine insights. There are also people with agendas, people who are trying to sell you something, and people who are simply wrong. Your capital is your responsibility. Do your own research, understand your own reasoning, make your own decisions. Sixth, Don't neglect the basics of secure storage and insurance if you're holding physical metal. This isn't theoretical. This is real wealth. Treat it accordingly. Whether that means a good safe, a bank deposit box, or professional allocated storage, have a plan that actually protects what you've acquired. Finally, don't forget about the rest of your financial life. Silver, or any single asset, should be part of a broader approach to financial security. You still need emergency savings. You still need appropriate insurance. You still need to manage debt responsibly. Don't sacrifice fundamental financial health chasing any one opportunity, no matter how compelling it seems. The investors who navigate these situations successfully are the ones who maintain emotional control, think probabilistically, manage risk appropriately, and keep perspective on the bigger picture. The ones who get hurt are the ones who abandon discipline in favor of excitement or fear. We've covered a lot of ground here, so let's bring it together. The silver supply situation has moved from theoretical to observable. The macroeconomic environment remains uncertain, with persistent currency concerns and structural debt issues that aren't going away. Industrial demand for silver continues growing. Investment demand is beginning to return. Historical patterns suggest we're in the early stages of a cycle, not the late stages. None of this guarantees any specific outcome. Markets are probabilistic, not deterministic, but the probability distribution has shifted in a direction that favors those who understand what's happening and position thoughtfully. If you already hold silver, your patience and discipline are being validated by current conditions. Stay focused on fundamentals, not daily noise. If you don't hold silver but see the logic in these dynamics, educate yourself, start small if appropriate for your situation, and build position methodically rather than emotionally. Most importantly, remember that wealth preservation and wealth building are marathons, not sprints. The decisions that matter most are the ones you make during the quiet periods before everyone else notices. The discipline that matters most is the ability to hold through volatility and maintain perspective when emotions run high. The crisis we're seeing in silver supply isn't the end of the world. It's a market adjustment that's been building for years and is now becoming visible. How you respond, calmly, thoughtfully, with appropriate risk management, will determine whether this moment represents opportunity or regret. Stay informed, stay disciplined, stay focused on what you can control. And remember that understanding cycles and preparing appropriately will always matter more than reacting to noise. Thank you for your time and attention. Think carefully, act deliberately, and take care of yourself and your financial future.